Good morning, everybody. Happy Thursday. Happy Ticker Thursday, I see someone mentioning. Indeed, we will get to that as well. I hope you all are doing good. And hopefully you can hear me as well. Let's quickly do an audio test. And then we're going to start. I need to charge my phone, actually. Cool. All right, let's get started. Very good. Okay, good morning, everybody. Serge Berger here from thesteadytrader.com. It's our morning call, Set the Market, Monday through Thursday. If you've never been here before, welcome. Please make sure you subscribe to the channel. It's absolutely free. It allows you to be updated in real time when we go live with analysis and when we do all sorts of podcasts and vlogs and all sorts of stuff to help you become a better trader and investor. Also, please make sure you always give us a thumbs up like every single time you watch a video. That really helps us to be able to continue doing these shows, and it allows the algorithms to pick us up. Also, if you ever want to leave any comments, that helps even more. So that would be great. Cool. Okay, let's get started. Top few things on my thing. I have a big list this morning, actually. I do want to have a look at number one, what just happened this morning here with the producer price index. And see what that might mean for the near term for markets. Then we have a whole bunch of things that are actually very bullishly setting up for trades. But again, at some point this market's going to get overbought, and then all those signals are going to become invalid. So I think this will be a really good exercise here this morning. Bitcoin managed to close above 120,000 yesterday. It's reversing right now along with all the other risk assets. That's a whole nother thing I want to quickly talk about as well. So I would say let's get started. First things first, I'm going to quickly drop with you guys our official vlog number 2. That is something that was just posted yesterday here on YouTube. It's a behind the scenes look of what we do. It looks like this. If you go check it out, you can see that video. It just posted a few hours ago or something, so still low views, but people enjoy when we do these video blogs. It's kind of like a day in the life of kind of thing. It's a few days of travel that I recently did, and just people like to see that kind of stuff, kind of what we do to make everything happen that we make happen here for our clients, provide all the research. Anyway, if you want to go check that out, would love to encourage you to do that. That's the link. Also, yesterday I posted that book. Some people are asking us, "What can you share that book again?" Yeah. So what we talked about here yesterday, really quickly, is we would encourage everyone to read a book. It's called the House of Morgan, and I don't know where. I have a picture somewhere of that. Oh, here. You guys can go get that pick it up on Amazon or whatever your favorite book retailer is. This one here, I would encourage everyone to read this book. It's a really thick book. It's a big one, so you're probably not going to be able to read it in a day or two. But it's a great read, and it's really, if you want to be a student of the markets, I think this is an absolute must read. It certainly is for most people that work on Wall Street. So. That's the other point. Now, let's start by having a quick talk about this morning's producer price index. So what happened? The consumer price index on Tuesday, which we talked about here, that it would be a market-moving event, was a market-moving event to the upside. So let me show you guys what that actually looks like. I'm going to go into our economic calendar so you can see this a bit better. So this is what I'm talking about. What I'm referencing now is Tuesday. So Tuesday's inflation report essentially came in again roughly in line. It was about 3%. I think the consensus was about roughly around that. So there wasn't really a big change. So this is kind of what that you can see that inflation rate having come down over the past few years. What we just had, though, is the producer price index. And the producer price index, and it hasn't updated here yet in terms of the actual print. This is the year over year, is the month over month That was the one that spooked people. So here, the month over month that just came out this morning was actually 0.9, and it hasn't been updated here yet. But I'm telling you, the expectation was for like, this is what producers pay, like factories and stuff, right? So the factories are feeling the pinch of higher inflation. The reason the consumers haven't felt it yet, there might be a part of that might be due to the makeup of these surveys. That's always, statistics. There's, lies, damn lies, and statistics. But if you want to kind of ignore the noise, the reason why the consumer wouldn't have felt it yet, or as much, is maybe because some of these companies have kind of swallowed that higher inflation cost, and not pass it on to the consumer. Now, what does that mean? If the producers are not passing or haven't passed it on to the consumer, that means that they're swallowing it themselves, which means their margins are coming down, which should weigh on stock prices, right? Really simple math. Again, listen, these things are more complex and they usually get revised, so it's all a bit of voodoo. And so, but that's the basic sort of kind of thought process in terms of why that goes, and why this morning you may have seen that the equity market is trading lower. Now, the other thing that's happening this morning, and this is one thing I know a lot of people that are new to the markets, meaning have only done it for the past 10 to 15 years, have only seen one cycle, which is a bull market, haven't fully, I think most people haven't understood this yet, that have only been around this for 10, 15 years, is that risk assets go to a correlation of one, right? When it's risk off. So you look at this morning, for example, and you look at the move lower in equity futures, that's this. So this is the equity market this morning, the S&P or NASDAQ futures going straight down, right? And along with that, pretty much everything else, right? Like what? Like, for example, Bitcoin, right? Again, this is the short-term stuff. It's straight down. Bitcoin's now down 3.6% after being mostly flat on the day before, and it's now still hovering just south of 120,000. So, I think people haven't really comprehended that when things turn, it turns all in a dime, and risk assets correlation goes to 1. So that's just a bit of a risk management exercise, sort of risk management talk on my end. At the same time, and this is now hurting me a little bit. Luckily, I'm way more short equity futures as a hedge than I am long 2-year notes. This is what's happening in yields. So we talked about this yesterday morning on the show and to clients throughout the day. Is that 2-year bond yields? I said specifically if they were to drop below 3.6-ish. 65% or so, we could probably go towards 3.5, 3. We didn't drop below 3.5%, 3.6-ish. We kind of bounced right there. So now this is a lot of noise right now, but I would just watch this very carefully, because on one hand, the Fed can't cut rates if inflation is high. On the other hand, they will be forced to cut rates if the economy slows, right? So this is a catch-22. This is that sort of stagflationary environment that some people talk about. I have a hard time handicapping that, to be honest with you. That's why I try to focus on more sort of factual stuff, which is, at the end of the day, is how smart money investors react, and B, of course, what the charts, if you will, are telling us, and the hard data. So that's kind of a nothing burger for me this morning. Right, short equities as a hedge, yet long essentially a 2-year futures, because I think yields will go down. So I just want to give you a quick position update on all of that. Now, what's really interesting is if you look at all of this, you will also see that on a day like this morning, the price of gold it's not doing a whole lot, right? So I'm going to quickly just show you the price of spot gold. You can see the price of gold is not doing a heck of a lot. Now, the equity move this morning isn't really that big, right? But the price of gold isn't really doing anything either. So to me, I think people need to try to kind of make up their minds here. I'm not really quite sure how this shakes out, but I think the room for error on equities here is very, very small, right? I don't think there's a whole lot of room for error. And so I wouldn't be surprised if we finally start to get that sort of 5 to 10% corrective move. That can happen quickly. It can take its time, but you sort of typical 5% corrective move will get you down to 610-ish on the SPY, and 5% lower would be another 10%. 5% on top of that would be closer to 580 or so. So this is just something to keep in mind. I don't know how quickly, if and when, but this is something that we're watching. Now let's talk about a couple other things that I think are really critical. We've seen a pretty important move in home builders this week. Now, home builders, all else being equal this morning, should be trading down. Yeah, so home builders should, and they are trading. I was just checking pre-market, like Toll Brothers, right? You can see Toll Brothers this morning is pre-market down about 3.5%. Why? Home builders had a big run the last 2 days because the Fed basically, because of lower inflation on Tuesday. But today's producer price index is telling us the opposite. So home builders should be coming down. So this market, to me, is on the edge is dancing on the knife's edge, meaning if rates are going to stay low, or if the Fed is likely to cut, then yes, these stocks could run a bit more. But it's really, many things are priced to perfection. So at this point, having a somewhat higher than actually very, very much above expectations. The PPI this morning, again, expectation was for a 0.2% increase. The number actually came in at 0.9. Again, that might be revised going forward, yada, yada. But, that's a pretty big move. And so I would expect, if we see further sort of confirmation of that, then these equity markets here are priced to perfection, to say the least. Home builders and such would then have to start going lower as well, along with everything else. However, let's just not totally be bearish. There are things that, to me, are very constructive. We're very constructive, sort of more fundamentally speaking, on things like biotech stocks. We've talked about that quite a bit, right? These biotech stocks like IBB are continuing to act very well. You can see a nice move yesterday. But again, my concern is that a lot of this stuff is, this rally of the past couple of days was just because, in fact, it's probably factual at this point, just because that people were betting that rates go down. But like, for example, look at the Russell 2000 this morning. The Russell 2000 this morning is trading off, let me show you the number, is trading off about 1.5%. So like this, here's the chart here. I'm going to show it to you here. We had a big rally in small cap stocks, and over the past couple of days, again, because of lower expectation of rates, so rate cuts. So minus 1.5% basically erases the majority of yesterday's rally and could set up for a really big bearish reversal. Now, the other thing to keep in mind, everyone wants the Fed to lower rates, and they might. I don't know, right? It really depends on the data. If they cut 50 basis points in September, like, that's in many ways it should be a warning sign more than anything. Because if they're cutting that much, they're cutting likely because growth is coming under attack, right? So I know everyone wants lower rates. I get that. I'm not even necessarily disagreeing with it, but I just want people to understand that there could be big portfolio managers, pension funds, the people that really control the money flow, even some algos, that will take that as a warning sign rather than, oh, everything's awesome. So that's, we've never really had ever rate cuts at the rate of inflation that we have right now. And so that's, I think, something we need to keep in mind. It's Ticker Thursday, so I want to get to some tickers. If you guys have some tickers, let me know. I have one more specific trade idea that I would like to share with you, and that is in Intel. So let me show you this one. Now, again, Intel being a risk asset, meaning, it's a stock and a more high octane stock. But so this could totally reverse. But if the stock holds up, and we have to make a call here this morning, we're going to be monitoring this pretty closely here this morning in our members area. But I do think if the stock manages to hold in, then it should be able to fill that down gap from Thursday, July 24th, which is just a couple percent from yesterday's close. But of course, the stock this morning is down about 1.5%, like everything else. So, so if we see some sort of intraday bullish reversal, then I think Intel could reach that full gap fill around 222 at 2264. 2264. All right. Now, Nubia wants to look at Ethereum. But first, before we look at Ethereum itself, let me actually get to one more thing. Okay? I want to quickly show you a chart that we talked about on Monday, right? This is that chart that is either going to work or everyone's going to be wrong. So this is the equally weighted S&P versus at the top versus the regular S&P 500 at the bottom. You can see the regular S&P 500 broke above its February 2025 highs in June, and it's been pushing higher largely due to a few stocks. We all know who those are. The equally weighted S&P has been trying to break out. It hasn't done it yet. And of course, over the past 2 days, got very close to doing it because of that lower rating expectation. So quite frankly, it's really critical right now to see how markets react. Like, this is a really pivotal point. I don't know if they take the CPI series, the consumer price index, which came in more or less in line on Tuesday, so the equities rallied, or if they're now going to panic based on the producer price index, which came in 0.7% hotter than expected. I don't know. I'm sure some really smart 22-year-old with no experience and a couple of charts, wearing underwear in front of his computer is going to tell you exactly what's going to happen. Note the sarcasm, but for the most part, no one knows. This is just an honest assessment. So we need to just now, all I can tell you is I think markets are dancing on a very, very, very thin edge right now for the near term, like near term being a few weeks to, a couple of months or so. That's my honest assessment here. But again, I'm sure some know-it-all on YouTube will tell you exactly what you need to do, as they always do. So let's quickly talk about Ethereum. So the most important chart that I can show you about the Ethereum and that stuff is the following. And I thought I had the chart here, but I have to reconstruct it. So let me show you this. So this is the chart that I would like to show you. I'm going to make this a longer-term weekly chart, and I'd like to share with you. We have been displaying this chart to clients now for a few months, and this is essentially the ratio of Ethereum to Bitcoin. And you can see it obviously hasn't been around for that long. It's been about 8 years or so. But you can see when we reach that ratio of around 0.02, Ethereum typically had a sharp rally, which it's once again having now, right? So that's important, I think, to keep in mind. So I think Ethereum could continue to outperform. However, so that would be your ETHA ETF. I would be a little bit more careful now on these assets because, and let me make this a daily chart, because Nubia, because risk assets have a correlation of 1, right? So the biggest question I have right now is if inflation comes in higher, I wonder if Bitcoin and Ethereum can continue to rally. Historically, they have not been able to do that, right? They would consolidate, at least in the short term. But if people start to perceive that higher inflation as leading to lower growth, and people start rotating into other assets because of further monetary debasement, which is really why people are going into things like particularly Bitcoin, then these things can continue to go higher. So just keep in mind that the correlation this morning, as you saw, right, Bitcoin, that's this yellow line straight down, along with pretty much everything else. So these assets are, in my view, not going to be a hedge, if you will, against equities. In fact, quite the opposite. But it's possible if something dramatically changes, like structurally, then they could. I wouldn't, in the short term, I personally would not bet on that. But again, through a multi-year lens, that's more likely. Okay, so hopefully that makes sense. Now Jeff wants to look at NVO. So this is Novo Nordisk. Now Novo Nordisk is I actually have a friend of mine who used to work. That, I need to be very, very clear, don't get into trouble. Here's the thing about Novo Nordisk. I personally think that company could turn things around. One problem with Novo Nordisk is they have a lot of patents expiring, and they're going to have to come up with new stuff, which is very expensive. So that's a fundamental, potentially, headwind. If you want to just talk about charts, here's the chart that I've been showing around for the past, few months to investors that may give you a little bit of perspective as well. This is now a chart that stretches back, I believe, 35 years, starting basically in the late 1980s. So this here is now where Novo Nordisk has dropped to, and we can make this like this, okay? So this is now more or less, Jeff, and you tell me if this is helpful for you. This chart here is Novo Nordisk's 35-year or more chart, and again, you can see that we have now reached the very low end of that long-term trend. Let me just quickly pause there if that makes sense, if you can see that, Jeff. What I'm seeing on my work is that I don't know if I want to necessarily buy the stock for a long-term commitment just yet. But if you know our framework of how we like to look at things here at thesteadytrader.com, we have 3 things we like to look at. We like to look at extreme oversold over overbought. In this case, we're looking at an extreme oversold. We like to look at trend following, which would be the major trend that we want to respect. And we look at momentum. Right, that's the trender indicator, the third one. So this, to me, would fall into the not only the long-term trend following, but certainly the short-term oversold. Right now, what does that mean? Does that mean I just go blindly buy the stock? Not for me personally. And I haven't done it yet, but I'm going to do it probably tomorrow or next week. I typically will get into a situation like this and sell some way out of the money bull put spreads. That's typically what I like to do, which is to say that I would make the bet that the stock doesn't go a heck of a lot lower over the next few weeks, right? But that it doesn't necessarily skyhook to the upside either. That it's going through a consolidation phase here at a 35-year sort of a channel. Then John wants to look at QBTS. I have no clue what that is, but let's have a look at it. QBTS. Oh, gosh. That quantum stock? Yeah, I don't know what to tell you. I mean, it's a high octane quantum stock. So on something like this, John, I just would say this is a momentum trade. Right? So let me see what the hell this thing is even doing. QBTS pre-market. So pre-market, the stock is down not a whole lot. Yeah, a couple percent, which isn't one line. Now so for something like this, John, this to me is a momentum stock. I mean, there's no doubt about it. I'm going to go out on a limb and imagine that you're seeing this, right? Tell me if I'm right or wrong on this, but my imagination would tell me that you are probably looking at this. Someone sent you a chart and said, hey, this has this beautiful cupping thing and it's going to break higher. Tell me if I'm right or wrong on this one, John, right? So they're seeing this, and I wouldn't disagree. The problem is, if there's no momentum, I have no interest in something like this for me personally. I need to see actual momentum. So let's have a look where our momentum indicator is coming down. I don't even know if we have this on. Let me just see, QBTS. A signal, I'm just pulling it up. Yeah, okay. So no, we do, but it's very, very choppy. So this stock is in what we call the chop zone, right? So this is exactly one of those things where I personally would be very careful. So this is a stock, and you can see this. This is our momentum indicator. And if you guys don't have the trender yet, please go get it. You're going to do yourself a great favor by using a momentum indicator. So you can see we had a buy signal, a momentum buy signal down in May that ultimately got stopped out for a gain of 110%. Then we had a sell signal that got stopped out for a loss of 19%, so now you're up 90%. And then you had a buy signal that remains valid. However, the problem is we're in a chop zone right now, John. We're in what we call a consolidation phase, a chop zone, which is this, right? So until the stock can actually prove to me that it gains momentum above, let's say, $20, I think all this is a gamble in my view, right? But again, I understand what, someone probably sent you a chart like this, right? And I get it. This is classical, fourth grade, draw a line on a chart and make an assumption. But unless there's no momentum behind it, which we need to be verified by our momentum indicator, it's a 50-50 coin flip. It may ultimately break out. The question is, does that happen today? Does that happen next week, next month? Never, because all it is in this chop zone, which all else being equal, the stock could first go back down here again before it goes higher, right? But of course, the person that sent you this doodling math didn't really think about that, right? Because he's perceiving a breakout because for the past 15 years, that's what's been taking place. So hopefully that's helpful for you. Cool. All right. Listen, guys, in the meantime, let me just leave you with one more thing. Again, if you don't have a trender yet, please reach out to our team. It's support@thesteadytrader.com. Grab the indicator, the trender. You're going to absolutely love it. I guarantee it. Let me just quickly leave you with one more thing. 2-year yields are making a very, very, very big move in the opposite direction. So they are completely reversing. And this might be what stocks do now, right? So you can do the math here of whether bond yields are right or wrong. But bond yields went down, which is why stocks went up the past 2 days. Now bond yields are essentially reversing most of yesterday's drop, which should all else being equal mean that stocks are going to go have some pressure as well. So cool. Hope it helps, folks. We'll see you guys again back here Monday morning. In the meantime, please give it a thumbs up, like. Any comments, leave them down below. And also make sure you watch our latest vlog that we put up on the charts on the YouTube this morning. Thanks for being here.